Well, hello everyone. Welcome to the last live Schwab show of the week. My name is Barbara Armstrong. This is Getting Started with Stock Investing. And Connie and her fabulous red hair right now are in Washington, D.C. at an in-person event. She's there with Scott Durfee and Ray Kimbrell and Mr. Ben Watson. And today they are talking about the introduction to technical analysis. Tomorrow they're talking introduction to options. And so if you're interested in learning more about these things, and there is a live event, an in-person event coming to your area, they're free to attend. They're free for you to attend, and we would love to have you there. So what are we going to talk about today? Well, I thought I'd talk about the different reasons that an investor might buy a stock. And often it falls into three buckets. So we're going to talk about those buckets, and then we're going to go out and look at some example trades and add them to our example portfolio. And you might say, well, what are the buckets of which you speak? And I think, well, some people have a giant heap and they're looking to protect it. Some people are just starting out or starting over and they're looking to build a giant heap. Some people are looking, for income. And so how do we accomplish all of these things through investing in stocks? And so that's what we're going to talk about today. So I want to thank those of you who are not like having a nap and sleeping off the excesses of Halloween and that have showed up here today. I really appreciate you being here and being participatory in the chat. So hello to Carol and Jay and Will and the rest of the gang and David. We also have the privilege of having Mr. Kevin Horner with us here in the chat. So I appreciate his holding off his shopping for discounted Halloween candy until after this class. It's great to have you all here. If you have any questions, don't hesitate to ask. If you are not following Kevin and I on Twitter, what are you doing? You're missing out. So I encourage you to do that. Kevin's handle, Kevin Horner CS, my handle, Barb Armstrong CS. So there's that. Let's get through our important information and then we can get into delving into our buckets. Yeah. So, everything we talk about in this class is for information purposes only and shouldn't be considered to be a recommendation on the part of Schwab or myself. And while we are going to look at charts, also called technical analysis, there are other approaches, including fundamental analysis. So looking under the hood of the car, so to speak, being aware of earnings, being aware of what's going on in the market in general, all of these things we may want to take into account, right, when we're making an investment decision. Also, in an attempt to manage our risk, a lot of traders might consider using a trailing stop or a stop loss order, but know that if a stock gaps down, a stop loss order isn't a guarantee that we'll get out at a specific price. And if we use a stop limit order, we might not get out at all. So it's important to understand these protective tools that we might use and how they might work for us, but also understanding what limitations they have. And know that all investing involves risk, including the potential loss of principal. And so I'm going to have a quick look at, what this series overview is. I'm filling in here for Connie today. And then we're going to, kind of look at those three buckets. But over an 8-week time period, Connie has this really nicely laid out. So, talking about the difference between a growth stock and a value stock, and we're going to talk a little bit about both of those today. Looking at the charts or technical analysis, understanding when you may want to enter a position, understanding how to manage your risk, which includes both the use of perhaps something like a stop loss order, also maybe just understanding how to properly position size, and knowing when to exit. And, I'm a big fan of know when you're getting out before you even get in. And that may sound counterintuitive for people who are stock investors, but it's actually not. She spends a week on top-down analysis, which is kind of looking at what's happening in the market overall, then what's happening in each sector, and then going down from there. What kind of timeframes are we looking at? And we're going to talk about a little bit about this today too, because we're going to look at some shorter term timeframes and some longer term timeframes. So just to go back to give me a little bit of space to draw on here, I'm going to go back to my bucket idea, and that's that, often when we look at trading or investing, we want to have a goal, right? Otherwise, why are we doing this? And if you're in your 20s, you may want to build something up so that you have choices that would be different, when you're approaching retirement. Some of you may want to retire at 50 or at 55 or at 60 or, at whatever age. And some of you may say, well, it would have been nice if I had found this then, but I'm now in retirement and I already have a giant heap, or I have investments and I want to protect them. And that's my main goal, is that I don't want to lose what I have. And then some are looking at it and saying, I wish I had a significant portfolio, or amount of money to invest, but I don't. So I'm looking to grow my account. So my primary focus is growth. And there could be a third group of people that have, maybe you said, well, I have some investments, but I've decided to leave a job that was sucking the soul out of me, and I'm pursuing my passion, but my passion doesn't currently pay me the way the other job did, and I have a bit of a gap. And so I'd like to generate some income. Or maybe you've retired and you've certainly got enough to cover your day-to-day expenses, but maybe you'd like a little extra to be able to do some traveling or, whatever you want it for. I'm just throwing out ideas here. Maybe you want to spend Christmas in Paris, or you want to spend, some of the summer on the French Riviera. Yeah. So, whatever it may be, or maybe there's just a really cool thing that you've been eyeing and have wanted for a long time that you'd like to put in your driveway. Maybe it's an RV or something like that. So whatever it may be, I'm going to discuss some of the ways that we can do all of these things. And you can't necessarily do all of these things at the same time. Some might argue that there is that possibility, and we'll discuss that also, but we're going to start here with door number 3, which is income. And we can earn income a couple of ways. So one, we can find a stock that pays a dividend. Now, with dividend paying stocks, there's no guarantee that it's always going to continue to pay that dividend. So we have to be aware of that. But the other thing we could do is a short-term investment. So that stands for short term, with a target. And so we just want to get in and own that stock for a short period of time, and then we want to exit. And you might say, well, how short a period of time? And how might I choose the exit? And I like the way you're thinking. So let me just hit my Etch-a-Sketch and let's come out and have a look. So, as many, or maybe most of you are already aware, the S&P 500 is up 20% this year. Even at, it recently hit a new all-time high. This is a 1-year chart. Year to date, this index is up 20%. On average over the last 50 years, through all the ups and downs, this index has averaged, about an 11% annual return. So, there's not, who knows what will happen in the last 2 months of the year, but we're kind of ahead of the norm, so to speak. And the same for the NASDAQ, which is also, and this is a more tech-heavy index. About 50% of this index is comprised of tech stocks, or And it too hit a new all-time high back in July, went through a period of consolidation. But if you had a really good arm, you could kind of hit that high. Like it's over 20,000. And so, many people would consider this to be bullish also. And then when we look at the Dow, now what's the difference between the Dow and the other indexes? Well, the main difference from my perspective is far fewer stocks. So 30 stocks as opposed to 100 on the NASDAQ, and you have 500 companies represented on the S&P 500. This one has 30, and this index is based on the price of the stock, not on its market cap. And so if the price of the stock, they do a 4-for-1 split, like Apple did a few years ago, then the impact on this index of Apple would be cut by 75%, where it wouldn't, although Apple is part of, like if we come and when we look at these, Apple, is a heavy hitter on the Dow. It also is a heavy hitter on the NASDAQ, as is Microsoft and NVIDIA and Google and Amazon. And as you can see here, this is organized by sector. And you may not notice that when you first look at it, but let me just kind of draw some lines here. And we're on the Market Watch tab if you're not familiar with it. So here's the tech sector. It's a pretty big chunk, isn't it? And then here's communications. And consumer discretionary is here. So there's the top 3. And there's 11 sectors. And then all the rest, like here's energy. Teeny tiny by comparison, right? And here's the industrial sector. Oh, I may have missed. Here's industrials. I may have missed these up here, sorry. They should be part of that too. But, it's utilities, tiny by comparison, to technology. So it's interesting sometimes when you look at this to have a visual. So someone in the chat is asking, what type of software we're using. If it's to draw the lines, it's a third-party software called Epic Pen that I just bought so I could draw on the charts. But this platform is the Thinkorswim desktop platform. And we're on the Market Watch tab, on Visualize, and on the heat map. And I'm just clicking in between. And so here's our S&P 500. Now, Apple, still, a heavy hitter, but it's more diluted because you have 500 stocks. Okay. So there's that. The first stock I wanted to look at today, and we looked at this earlier, and so this is kind of going to be our focus is on one of the ways we can generate income. If we look at General Motors, it's a car company. I lived in Michigan for quite a while. They're one of the big 3. If you weren't familiar with the company, you could come here and have a look, and it'll give you a description. And when you go up to the top, it'll tell you what sector it's part of. And it's part of the consumer discretionary sector. We can also look at, this stock has been uptrending. It went through a period of consolidation, and then it broke out. And you may say, this is all well and good. But it's kind of pulled back, and it's come close to this support level. And this is where understanding the charts can come in handy. And although it's not a guarantee that it's going to go back up, it was recently, trading at $54. So, it came up here on October 22nd, and it closed it hit a high of 54.18, and then hit a high of 54.19 the next day. And then on day number 3, it went up to 54.30. Well, what if we put in an order to buy it now and said, when it gets up to $54, we'll sell it? And we could do that. And that's called a swing target. And I've kind of drawn it on the chart here for us. So, we could buy some shares of GM and then put in an order to say, and when it gets to $54, I would like to take the money and run. Cue Steve Miller. And so if we bought 100 shares and we could buy it for $50.96 or call it 51, and I can sell it for 54, how much have I made? Well, I've made $300 on 100 shares. And one of the things we might want to look at is, well, what's that as a percentage of my investment? Because I'm paying $51 to get in. And so if I take that $3 that I'm hoping to make and I divide that by 51, that's about a 6% return, 5.88 or 5.9. Now, if I want to define my risk, where might I put a stop? Well, I might say, well, I see that several times it came up to this kind of $50 level, and now it's coming down. I mean, it's come down to 51. What if to be conservative, my expectation is this old ceiling would act as a new floor? What if I put my stop 3%, 2 or 3% below that 50 mark? And so if I look at that and say, okay, 50, if I took, I've got to get rid of my drawing tool here. If I take this 50 and I multiply it by 0.97, 48.50. So how would I enter that? And this is $1 million account. So let's say I'm willing to have a $20,000 position, which for this account is not high. Like a $50,000 position would be 5% of your account value. So we're going to come to the trade tab and we are going to right click anywhere on this line and say that we want to buy with an OCO bracket, which means we want to put in both a target at which we'd like to get out, and we want to put in an exit. And so we're going to come up here and say, okay, we're willing to buy at 51, and we want to sell it when it gets to 54, or if it goes, in our opinion, in the wrong direction, we want to get out at 48.50. Okay. And how many shares were we going to do? Well, we were going to do 400 shares, which is about a $20,000 position. And this is pretend money, but I'm pretending we have $1 million in this account. Now, when we bring up our confirmation window, it says we want to buy 400 shares of GM at $51, correct? Correct. We want to sell if it goes up by $3 or if it goes down by $2.50. And what's the advantage of putting in this exit, before we even place the trade? Well, on the target, you could be out like walking your dog. You could be out buying Halloween candy on sale sometime next week, and it could hit the target just for an hour. It could go above 54, perhaps. And then by the time you get home and look at it again, it might be back under that 54 level. And so this will trigger a market order to sell. Now, you may not get out at exactly that price, but one would expect to get out somewhere in the neighborhood. Now, if it gapped up, that might be a happy circumstance. Maybe you'd get out for, 54.50. That's a possibility. The same thing goes on the downside. And what's the advantage of putting a stop order in? And in my humble opinion, It's because there are some four-letter words that tend to haunt us in the world of investing. And, they may not be the words you think. One of them is hope, as in it starts to tank, the stock starts to go down in value, and you start hoping it will go back up. This, my friends, is not a trading strategy. FOMO is another one. Oh, I'm afraid I'll miss out if I don't stay in the trade. This too, not a trading strategy. And last but not least, two F's and an H, fear. Well, I'm afraid if I get out now, it'll go back up and leave me behind. Well, you know what? That could happen. Have I seen it happen? Yes, it's happened to me. But then I have a plan for when I'm going to get back in. But sometimes things start to fall, and they fall for a very long time. And so putting in this exit helps us deal with these, which can be really, really painful. Okay? So this is our way of eradicating this from our trading plans. So before I buy this, I know when I'm getting out. Now, what if I just want to buy and hold for a long time? Well, maybe I don't want to put the target in then. And we'll talk about one of those too. Okay? But we're still going to put a stop in. And why is that? Because of this. Okay? Any questions about that? Yeah, somebody's saying, I love the four-letter words. Yeah. Yeah, it made sense to me. Okay, you want to see another example with a target? We're an intimate group today. There was something else I was going to show you. Oh, yeah. And you may say, you know what, Barb, like I know a lot of other people have issues with hope and fear and that kind of stuff. Yeah, I'm not like that. Well, I didn't think I was like that either. Yeah, and you know what? Sometimes it's like, despite your best efforts, here's a 5-year weekly chart on Peloton. And so, if you had bought in when this was going up during the pandemic, and you may have thought, well, they're good bikes and it's a good company. And I'm not saying that they aren't good bikes, but I'm just throwing ideas out here. And if you decided to long-term buy and hold and never put an exit in, like it's now trading for $7. Like it has fallen in value. Okay, let me just change my drawing tool here. If you want to see like just how ugly. That's a 97% fall from Grace. Ouch. You may say, well, that doesn't happen very often. Well, how often does it have to happen for you to feel really terrible about it? And, if we go back even further, at one point, this stock hit $100. That was back in 2018. And, how much has that fallen? Pretty close to the whole way, 98%. And so when we look at these things, are we saying, okay, now I've got religion. Now I hear what you're saying. Yeah, I hope so. Okay, so that's GM. If we want to see another example in this short term, and are we expecting, when we go back to GM, are we expecting to be in this for a long time? No. But if it goes sideways, we see this green dot over here. What does that mean? It means it pays a dividend. Now, it doesn't mean it's going to pay a dividend forever. I did say that dividends could be canceled, and it doesn't pay much of a dividend. The dividend is only like just under 1%, but it beats a poke in the eye with a sharp stick. So, and this also has a PE ratio of 550, which is, for some value investors considered to be quite attractive. And you might say, well, I'd expect it to be good. It's a $50 stock. Well, the price of the stock doesn't have as much to do with it. What this is saying is, for every $5.50 you invest in this company, in this stock, it generates $1 worth of income, $1 worth of earnings. Okay. So, that's considered quite strong. Now, let's look at another one. Let's look at American Express. And here, our price earnings ratio is almost 4 times higher. It's 20. And you may say, well, that's not so great. Well, a value stock is considered to be a stock that has a price earnings ratio of under 20. And if you take that and you compare it to, say, a NVIDIA, that's a growth stock, their PE ratio is 63, or a Tesla, where it's 68. So American Express, of course, it's a conservative company. It's been around a long time, but you may say, well, I'm looking for, to add to my monthly income. I want to take the grandkids to Disneyland, or, whatever it may be. And so it closed today at 272, but, just mid-October, October 17th, it hit 286. So, again, we have $1 million account. Could we buy 100 shares and say, you know what, if and when it goes back up to 286, I'd like to sell. I'm just looking to make a little bit. And this isn't a long-term buy and hold strategy. I'm not marrying. We're dating for a short period of time. Yeah? Okay. So somebody's saying, I don't think this is a good income strategy. I think you should buy a company like Altria, with dividends, and sit back and collect. Well, if you have a really large account, it depends on how much you want to earn, and how much risk you want to take. Because, for some people, they're looking to they may have part of their portfolio invested in stocks that pay a dividend. This is just another way. It doesn't have to be all one or all the other. You could do a little bit of both. So I'm just trying to give you another idea. If you're saying, well, I've got these dividend investments, but I'd like something to kind of give me a little bit more of a boost from an income perspective, without having to touch, this other established part of my portfolio that's already invested, and that I don't want to liquidate those positions. So if we looked at this and we said, well, it's kind of been sitting on a bit of a ledge here around 266. What if we considered that to be our support level? And we said, well, if it goes below 266, by 3% or more, so we're going to make that 0.97. So if it goes below 258, I want to exit. And if and when it goes up to 286, I'd like to exit. And so how much could we make? Well, we could make 1,400 if it went up and hit that 286. And how much could we lose if it came down to 258? Well, that would be 14. So we're risking $1 to make $1 potentially. Now, if it keeps going up, do we have to leave our stop at 258? No, we could move it up as it gets closer. But if we want to add this, again, we're going to come to buy custom with an OCO bracket. And often in the after hours, the bid-ask spread can get a little wonky. So we're going to put in here 272.69 or 272.70, and then we'll just check it on Monday, 272.70. So a penny above where it closed. And we want to get out if and when it goes up to 286. So back to where it was before. That's why we call it a swing target. We're going to make that good till canceled and this good till canceled. And then we're going to put our stop loss order at 258.02. And we're going to put that in our stock with target bucket. And of course, the market is now closed. So if we wanted to look at a dividend stock, and there's a couple we could look at. So we could look at T-Mobile. So, T-Mobile has, it's up 31%. And so you might say, well, isn't the horse already out of the barn? Like, didn't we miss the opportunity on this? Well, it's actually been consolidating and kind of going sideways. Excuse me. Had a good earnings report. And so we might look at this and say, well, what is the PE ratio on this? It's 18, so that would put it in the value stock category. It's in the communication sector, which has been hitting, new all-time highs, and it pays a dividend of 5%. So there's nowhere for it to swing to. It's already at a high. So maybe I just want to add this to my portfolio. And as long as, if you wanted to do this as a longer term trade, this is a 30-day moving average, this is the 100, you might say, I just want to add this to my portfolio. I'm hoping that this will continue to grow, or my expectation is that the value of the stock may continue to go up, but it also pays a dividend. Yeah, and do I have AT&T in this account? Doesn't look like it. Oh, I may. Actually, I don't. And but we're just doing this as an example. Now, what else could we look at? We could look at T-Mobile. And T-Mobile, now this is a much more expensive stock. And this looks like, this is up almost 40% year to date. And again, have we missed our opportunity? But, it's kind of an object in motion. How does that expression go? I'm not a science person. Stays in motion. You've got momentum kind of, in your direction. And if we come to the trade tab, has a price earnings ratio of 25. So a little high to be considered, a value stock, pays a dividend of 1.5. And so there's lots of other stocks we could look at. We could look at Altria. PE ratio of 9, pays a dividend of 7. Well, let's look at the chart. So when a stock gaps up like this one did, some might say, you know what, I'm going to keep this on my radar. And so I'm going to and we just did this yesterday in another class. We created a personal watch list, and it says, watch this one daily. So we could just add that one and say, maybe we want to wait just a little bit and see if it kind of comes back down. And it may come back down, or Monday, it may start, moving on up again. Or, it could pull back all the way to where it gapped up from. We just don't know. Okay, but if we go back to our example on AT&T, and we say, okay, well, it's up 31%, and we might look at this and say, hey, if it continues to go up, I'd like to buy it. So we could put in a conditional order and say, but this was a new high. Others might just say, you know what, I'm willing to buy it now. And you can do this however you like. Okay. So, and it may be Jim is saying that I have AT&T. Connie may have this in her example account, but let's just say we don't have it and we're going to add some shares. Now, where might we put an exit? If we want to be a long-term buy and hold, we might even use this 100-day moving average. If you're saying, oh, I don't want to, go back that far. And this is kind of misleading because this is 2273. This is 20. So this is, about a 15% gap. Others might say, well, you know what? I'm bullish. I think this is going to continue to go up. So I'm going to look at this recent low here of 2105. And instead of using a 3% below, you might say, I'm buying this from a longer term perspective. So I'm going to use 5%. Or you may want to use, a 50-day moving average. But if we're using 5% below a recent low, our recent low here is 2105. So we'd say 2105 times 0.95. So we're going to put our stop at $19.99. And when you get that close to the $20 mark, we may want to make it $19.89. So we're going to make it $19.89. And we're not going to put a target on this because we just want to own it, have it pay that dividend, and hopefully tick two or three of our boxes, pay some income, grow the account, and we're protecting our position by using that stop loss. Again, not a guarantee. So we're going to right click, and we want to this time buy custom with a stop. And if we're saying, well, we're okay with having a $20,000 position, how many shares could we buy? Well, if we bought 1,000 shares, that would be 22,000. So 1,000, that's a $22,000 position. So if we're okay with that, we're just going to come in and put our stop at $19.89. And continue on our way. And we're going to put this in, you could put it in your dividend bucket. It does pay a 5% dividend. You could put it in growth. It just depends on, what you want to do. So we're going to put that in our dividend group. Now, we have just bought this, or we're looking to buy it on Monday. And so we're looking to enter it here. And our stop is about here. It's going to be at, well, I'm going to change my drawing tool. It was about 1989. Now, what if we had bought the stock back here? And the low was 1673, but let's say we bought it at 17 and our initial stop was down here. First of all, I want to say stops do not last forever. I think it's 6 months on the Thinkorswim platform. But if we had a stop loss order, let's say we bought it when it first bounced here, our stop might have been here. And then when it came back and kissed this 30-day moving average, we may have said, well, let's move it up a little bit. So we might have moved it up to here. And then it continues on up the hill. And after earnings, it moves up again. And so we say, well, here was a recent low. Let's move our stop to here. And then it continues up and comes down and it's below that 30-day moving average. So we may have said, okay, well, let's move the stop up to here. And then when it comes and kisses the 30-day again, we might move our stop up to here. And then it's rolling along, doing just fine. And then it starts pulling back. We may have moved our stop, up to here. And it's possible, we could have been nicked out on a wick here, which is very frustrating. And so what some people will do is over earnings, they'll take the stop loss order off just to prevent getting nicked out. Because if I look at, and so just because we've bought this now and we've started with a stop here, if it does continue up, that isn't to say that we won't, in the beginning, we're just trying to manage the risk. And then as we go, we're trying to protect some of the profit. Does that make sense? I hope so. But if we look at, if we had moved our stop up on this day to 3% below, or no, with this one, we were using 5% below. So the low that day was 21.21. Times, to make it 5% below, it would be 2014. And on this day, it came down to 2105, so we wouldn't have been stopped out, and then 2105. So if we had used that 5%, we would still be in this trade, and our stop would be at $20.15. So higher than where it is now. Okay. Okay. So we've looked at two examples of creating income over a shorter term time frame, which could be days to weeks or maybe even a month, by buying stock and putting in a short-term target, which we're calling a swing target. And the examples that we did for that were General Motors. And we were just looking at, okay, we're just going to buy it and trade it till it gets back up to the previous high or somewhere in that neighborhood, and American Express. And then we looked at an example of, well, what if we looked at something that paid a dividend as well? So now we're trying to generate income a couple of different ways. And the next time I fill in for Connie, maybe we'll just do the growth thing. But and then I will follow up, and we can look at these and see how they turned out. And this one, our target was 286. So if you want to put that on your chart, I just right click, create a line, and then write down target, and then say, let's show that on the right. And bada bing, bada boom, I've got my target. Now, I have the default set for these lines to be blue and a dotted line. So when you come down to edit, you'll see style. You can make it a solid line or like little dots if you want. I make it thicker because I'm teaching, and you can make the color whatever you want. Okay, and then I like the price to show up on the right. And so I have that. The default is for it not to show up. I changed the default to on the right. So now you see I've changed the type of line. So guys, thank you so much for ending your trading week with me. Of course, there's always the opportunity to subscribe to this channel, and then instead of binging Netflix, you can binge in the archives previous sessions. So I'm asking, if you haven't subscribed, you may want to do that. Second thing, if you haven't hit the like button, this is a chance to let me know and Kevin know that you found this content valuable. But more importantly, it moves it up in the YouTube algorithm so that more people can find this. So hitting like would be appreciated if in fact you did find this content helpful. And then last but not least, you're going to want to follow us in the land of X, Kevin Horner CS, Barb Armstrong CS. So that's a wrap for today. I do believe that Connie will be back next week, and I hope that you will join her there. Enjoy your weekend, everyone. Stay safe. Don't forget to get out there and hug someone you love, and we'll see you Monday. Bye for now.